The experts declared the rally was finished. They insisted the New Year's Eve sell-off marked the finale. Yet this morning, on Monday, January 5th, global markets opened to an unprecedented situation, a situation where traditional technical analysis becomes irrelevant and global power dynamics dominate. Check your trading platform. Silver prices have climbed to $75.60 per ounce. We've witnessed an increase of nearly $4 within a single session. The previous decline has been completely reversed. Resistance levels have shattered. We've now entered what market analysts describe as a melt-up phase. Understanding the catalyst behind this movement is essential. This transcends simple supply-demand equations. This goes beyond solar technology or electric transportation. What's unfolding before us represents the reemergence of conflict-driven premiums in precious metals. During the weekend closure, a geopolitical shockwave rippled through financial news networks. Confirmation arrived that American armed forces initiated a strategic intervention in Venezuela. The official narrative centers on governmental transition. However, the underlying message that trading algorithms detect involves natural resources. The former president once stated regarding Venezuela that America could have secured access to those oil reserves, conveniently located nearby. Market participants recall that statement, interpreting current military engagement not as diplomatic maneuvering, but as resource acquisition. When the world's dominant military power mobilizes toward the planet's largest petroleum reserves, it transmits a clear message to every sovereign nation. Protect your resources or forfeit them. This anxiety sparked an enormous flight to safety. Investment capital evacuated risky positions. It abandoned government bonds and rushed into the only two instruments offering zero counterparty exposure during armed conflict: gold and silver. Throughout this comprehensive 5-section analysis, we'll deconstruct the extraordinary convergence of factors that struck markets today. We'll examine the three relentless drivers: warfare, price differentials, and systemic failure that synchronized at 8:01 a.m. this morning, propelling silver upward. We'll demonstrate how the Asian demand vacuum now accelerates prices faster than futures markets can process. We will reveal the institutional squeeze, how short position holders attempting to balance their portfolios last week were crushed by geopolitical momentum. The price chart displays green, but the catalyst flashes red. This chronicles the conflict candle. To comprehend today's violent price action, examine the timing. The movement didn't initiate at New York's opening bell. It began Sunday evening when electronic trading platforms activated. Silver didn't gradually tick upward, it gapped. The price leaped from $71 directly to $73 within 60 seconds of trading commencement. The explanation? Sophisticated investors don't await official market hours. Sophisticated capital interprets geopolitical signals. Upon reviewing Venezuela headlines Saturday, they anticipated Monday's outcome. They forecasted oil price spikes. They predicted uncertainty surges. They recognized that during military engagements, silver functions as accessible gold, but with amplified volatility. Consequently, they submitted market-on-open purchase orders. Thousands of contracts flooded systems simultaneously. This generated a liquidity void. Sellers vanished. Who maintains short positions when American military forces are deployed? Nobody. Therefore, prices had to jump instantaneously to locate available sellers. This gap holds significance because it trapped bearish traders. Anyone holding short positions Friday evening, anticipating a pullback, awakened Sunday night facing 20% margin losses. They were instantly underwater. Their forced purchasing, their panicked covering, added combustible material to the fire, ignited by conflict news. We must examine the Venezuela situation more deeply. Why does South American turmoil impact silver markets? Because Venezuela symbolizes the entire developing world. It represents Mexico, Peru, and Chile. These nations produce global silver and copper supplies. When America takes aggressive resource securing action in one country, every other resource-wealthy nation grows anxious. They contemplate resource nationalism. They consider that if Americans are claiming oil reserves, precious metals might be next. Their response? Hoarding. Export restrictions. Demanding gold payment instead of dollars. Markets are pricing a future where Latin American supply networks become disrupted or militarized. Mexico generates 25% of worldwide silver output. If Mexico observes Venezuela and decides to lock their vaults protecting national wealth, global silver availability drops by 1/4 immediately. The $75 price reflects markets attempting to price this supply disruption risk. It's a premium. Traders are paying extra today to hedge against the possibility they cannot access metal tomorrow. This explains why geopolitical rallies exhibit such violence. They're not founded on corporate earnings. They're driven by survival instincts. Observe gold. Gold trades at $4,116, up nearly 2% today. Gold leads during warfare. When conflicts escalate, gold appreciates. It's finance's oldest correlation. But examine silver. Silver has risen 3.5%, outperforming gold by nearly double. Why? Because silver represents a hybrid asset. It's simultaneously a monetary metal providing safe haven and an industrial metal serving as strategic resource. In conflict scenarios, you require silver for weaponry. Our previous military analysis covered this. Cruise missiles utilize silver, satellites require silver, combat aircraft incorporate silver. Therefore, conflict simultaneously increases industrial silver demand while boosting monetary demand. It receives dual catalysts. Gold only receives the monetary boost. This explains why silver provides leveraged exposure to chaos. During peace, silver performs well. During chaos, silver becomes extraordinary. Presently, chaos dominates. Prices reflect that dual demand. We must also consider the buyer on the opposite side of this transaction, the United States Department of Defense. With active South American operations, Pentagon material consumption accelerates. They're price insensitive. If silver zinc batteries for drones are needed, they pay prevailing rates. The conflict news isn't merely psychological, it's tangible. It implies the American government will shortly enter markets with unlimited funding. Traders are front-running the Pentagon. They're purchasing silver today at $75 because they know government procurement will occur at $100 next month, restocking arsenals. This establishes a price floor. You're not simply betting against banks anymore. You're aligned with the military-industrial complex. That's an extraordinarily powerful ally during bull markets. The bid is supported by Treasury printing presses and war machine demand. The conflict trigger ignited the fuse. But fuses require explosives for detonation. The explosive sits in China. While America focuses on Venezuela, China focuses on draining futures markets. The price differential we discussed previously, the arbitrage between New York and Shanghai, hasn't closed. Actually, it's widened. We'll analyze the Shanghai vacuum next. We'll examine how, while we trade at $75.60, China trades above $80. The West is distracted by warfare. The East is focused on accumulation. We'll show you why arbitrage algorithms are exploiting this spread today, forcing American prices to chase China higher. Conflict initiated the rally, but the vacuum sustains it. If you're monitoring headlines, you're watching Venezuela. You're observing aircraft carriers and oil installations. That's the prominent narrative. It's what drives algorithms and day traders. But while the West fixates on war drums, the East quietly executes history's greatest wealth transfer. A second force is driving silver to $75.68 today. It's not geopolitical, it's structural. It's a force so powerful it overrides the Federal Reserve and futures markets combined. We'll expose the Shanghai vacuum next. We'll examine the massive price discrepancy between New York and Shanghai that emerged this morning. While we trade at $75, China trades above $80. This $5 gap is hemorrhaging the Western financial system. It's draining London and New York vaults at mathematically unsustainable rates. Conflict provided the spark, but China provides the fuel. We'll deconstruct this arbitrage's mechanics. We'll demonstrate why metal flows eastward and why it won't return. We'll explain why American spot prices are broken. They no longer represent the global benchmark. They've become the global discount outlet. The store is open and China is purchasing everything available. Examine the numbers. Consider the hard data from Shanghai Gold Exchange. We received morning session data from Shanghai today. Physical silver prices in China closed the morning session at $80.87. Now check your screen. Futures market prices in New York show $75.60. That's a $5.27 difference. In normal functioning markets, this spread shouldn't exist. Arbitrage traders, finances predators, should eliminate it instantly. They should purchase in New York for $75, ship to Shanghai, and sell for $80, risk-free profit. This New York buying would push prices upward. Shanghai selling would push prices downward. They should converge toward equilibrium, but they're not converging. New York rises, but Shanghai rises faster. The gap widens. This reveals something critical. Chinese demand is insatiable. Even with metal flowing inward, prices continue ascending. Demand overwhelms supply. This transforms Shanghai into a magnet. It pulls global prices higher. New York must rise. It has no alternative. If New York remains at $75 while China sits at $80, every single ounce of American silver will be loaded onto aircraft and flown to Beijing. Futures market vaults would reach zero within weeks. To prevent this drain, futures markets must raise their bid. This explains today's 3.5% surge. It's not purely speculation. It's American markets desperately attempting to prevent inventory exportation. Let's walk through this drain's mechanics. Most people imagine silver sitting stationary in vaults, but silver flows like water. It flows downhill toward highest prices. Currently, the high ground is Asia. Bullion banks and refiners act logically. If they possess a 1,000-ounce bar in a London vault, and a London buyer offers $75 while a Shanghai buyer offers $80, who receives the bar? Shanghai receives the bar. This means the float, available inventory for Western investors, is vanishing. You might attempt purchasing a bar in New York, but the dealer responds, sold out. Why? Because that bar is already on a cargo flight over the Pacific Ocean. We're witnessing Western destocking. For 4 decades, the West held silver. Now, the East holds the manufacturing base. Therefore, they need the metal. They're using trade surpluses to purchase our strategic reserves. And because paper markets suppress prices, they're buying at discounts. This arbitrage operates like machinery. It runs continuously. It disregards sentiment. It focuses on the spread. As long as that $5 gap exists, the machine will consume futures markets. The only way to stop the machine is for futures market prices to reach 80. Why is China paying 80? Is it a bubble? No, it's industry. We must revisit solar panel data. China produces 80% of global solar panels. It's January. New production quotas for 2026 just activated. Factories in Jiangsu and Zhejiang provinces are ramping production for spring installation season. They need silver paste. They operate on inelastic demand. If a factory manager needs silver to manufacture panels, he pays market rates. He doesn't care whether it's $70 or $80. If he doesn't purchase it, the factory halts. Workers go home. Failure costs exceed silver costs. Therefore, Chinese industrial demand is aggressive. They're front-running the rest of the world. They're setting the floor price at $80 because that's the clearing price for physical industry. New York speculators are betting on chart patterns. Chinese industrialists are betting on survival. Survival capital always defeats speculative capital. This brings us to a profound realization. The spot price you see on television, the 75.60, it's a broken thermometer. It's supposed to measure global silver market temperature, but it's only measuring paper market temperature in New York. It's disconnected from physical trading reality in Asia. The room is boiling, but the thermometer reads mild. Smart investors know to check the street price. If Shanghai is $80, the real price of silver is $80. New York is just a lagging indicator. Eventually, paper markets will snap. They'll gap upward to meet reality. We saw this happen in palladium markets a few years ago. Physical shortage was so acute that prices doubled within a month. Silver is setting up for the same move. The Shanghai premium is the early warning signal. It's telling you that metal is worth more than screens indicate. So when you see a green candle today, don't think, silver is expensive. Think silver is still $5 cheaper than it should be. We're buying dollars for 90 cents. So warfare is driving safe haven demand. The vacuum is driving physical demand. But what about banks? What about entities short this market? They crushed prices on December 31st to balance their books. They thought they were safe, but now with prices ripping to 75.60, they're back in the trap. And this time, the trap is deeper. We'll look at the bank trap next. We'll explain why banks are now forced buyers. They must cover shorts into a rising market. We'll analyze short squeeze mechanics that activate above $75. We'll show you why smart money banks might actually flip long and ride the wave with us. The West is waking up to the shortage, and banks are realizing they're on the wrong side of history. We're looking at the squeeze. We've analyzed the war premium driving the safe haven bid. We've analyzed the Shanghai vacuum sucking physical metal eastward. These are external forces. But there's an internal force, a force right here on Wall Street, adding rocket fuel to this fire. The banks. If you remember our New Year's Eve update, you know banks smashed prices to $70.50. They did it to balance their books. They did it to lower their systemic risk scores. They thought they won. They thought they could crash prices, take the snapshot, then slowly repurchase in January. But they made a fatal miscalculation. They didn't anticipate Venezuelan conflict. They didn't anticipate China bidding $80. Now markets have reopened and prices sit at $75.60. Banks sold low. Now they must buy high. They're trapped in positions $5 against them on millions of ounces. We'll expose the bank trap. We'll explain why smart money looks incredibly foolish right now. We'll break down forced cover mechanics where banks must purchase silver not because they want to, but because their risk models demand it. We'll show you why the 75 breakout is the technical signal forcing algorithms to switch from short to long. They dump paper contracts to make their notional exposure appear smaller. It's a regulatory magic trick. Now you see the risk, now you don't. On Wednesday, December 31st, they executed this play perfectly. They dumped markets. They crushed silver to $70. They took the midnight snapshot. They celebrated. The plan was slowly repurchasing those positions over 2 weeks at cheap prices. But then Venezuela happened and Shanghai happened. Over the weekend, while banks were closed, geopolitical reality shifted. When markets opened Monday morning, prices weren't $70. They were $73, then $74, now $75 or $60. Banks are offside. They sold at the bottom. Now they must reestablish their hedges. They must repurchase contracts they sold to protect their physical inventory. But prices are running away from them. This transforms banks into chase buyers. They're chasing markets upward, paying any price to get back in. This regulatory whiplash is a primary driver of today's vertical move. Why is $75, $60 such a critical number? Because $75 was the line in the sand. It was the resistance level capping markets throughout December. Banks built a sell wall there. They placed thousands of limit sell orders to cap prices. Today, that wall was breached. When major resistance levels break, it triggers stop loss orders. Short sellers betting on a crash had their stops positioned just above $75. As prices crossed that line, snap, the stops fired. A stop loss on a short position is a market buy order. Therefore, the bank's own defense mechanism transformed into a weapon against them. Short liquidation became fuel for longs. This is technical analysis, fundamentals. Currently they're in a prisoner's dilemma. Imagine three major banks short silver. Bank A, Bank B, and Bank C. Prices are rising. They're all losing money. They all need to cover shorts to exit. But if Bank A buys, it pushes prices up. This hurts Bank B and Bank C even more. So who moves first? The first to panic and buy gets the best price. The last to panic gets the worst price. Therefore, the incentive is to panic first. Cannibalization. We believe we're witnessing early stages of this cannibalization today. One of the major banks, likely one with less physical inventory, decided to fold. They hit the buy button. They drove prices up 3%. They threw their colleagues under the bus to save themselves. This breaks suppression coordination. When banks stop working together, prices move to their natural level, and their natural level is much higher. We also must examine the options market again. With prices at 75.60, a massive amount of call options just went in the money. Traders bought calls betting silver would exceed $75. Banks sold those calls. Now that prices exceed $75, banks are on the hook. They must deliver the silver. To hedge this risk, they must buy futures contracts. This is gamma. As prices rise, they must buy more futures to stay hedged. Their buying pushes prices up, which forces them to buy even more. It's a mathematical feedback loop. It has nothing to do with Venezuela or China. It's pure algorithm. The computer sees price rises, calculates risk, and executes buy orders. This gamma squeeze acts as an afterburner on the rally. It takes a fundamental move and amplifies it into a vertical spike. In the past, when banks got into trouble like this, they had an escape hatch, the vault. If paper prices got too high, they would dump physical silver onto markets to cool it down. They would lease silver from central banks. They would sell bars from London vaults. Supply would flood markets and prices would crash. But today, the escape hatch is welded shut. We know from previous analysis that Shanghai arbitrage has drained London vaults. We know that the American mint is out of silver. We know that miners are withholding supply. Banks have no ammunition. They cannot dump physical metal because they don't have it. They're naked. This means the only way they can exit their position is to bid prices up. They must pay market rates, and market rates are whatever sellers demand. This is why this squeeze differs from 2011. In 2011, there was plenty of silver. In 2026, there is none. A short squeeze and physical shortage is the most violent event in financial markets. It's infinite money chasing zero goods. So, banks are trapped. Shorts are covering. Gamma is squeezing. This explains the move to $75.60. But this is just the technical move. This is just traders positioning themselves. The real money hasn't even arrived yet. The $50 billion from pension funds, the January effect capital, it takes days to deploy. It's a slow-moving ocean liner. It's just starting to turn the wheel. We'll look at the January wave next. We'll explain why buying pressure we saw today will accelerate tomorrow and Wednesday. We'll look at institutional FOMO, and we'll tell you exactly how to position yourself for the next leg up to 85s. Banks have lost control. Now the whales are taking over. We're following the big money. We've watched traders panic. We've watched banks cover. We've watched industrial buyers hoard. But all of that, all the volume we saw this morning was just the appetizer. The main course is being served right now. Monday, January 5th, marks the beginning of the institutional allocation period. This is a well-documented industry phenomenon where the giants of the financial world, pension funds, sovereign wealth funds, university endowments, deploy their capital for the new year. We're talking about entities managing $50 trillion of assets, entities that move so slowly that when they turn, they create tsunamis. We'll analyze the January wave. We'll explain why the shift from bonds to real assets is mathematically guaranteed to squeeze silver markets. We'll look at the total portfolio approach being adopted by giants like CalPERS and why climate solutions is just code language for buying silver. We'll look at the ETF squeeze. When a pension fund buys $100 million of SLV, someone must find the metal. And right now, vaults are running dangerously dry. Banks were fighting a skirmish. Pension funds are bringing the nuclear option. Let's follow the money. To understand the scale of what's happening, you must look at the difference between a trader and an allocator. A trader at major banks moves millions. An allocator at a major pension fund moves billions. For 4 decades, these allocators followed a simple rule: 60-40, 60% stocks, 40% bonds. They ignored commodities. They ignored gold. They ignored silver. They thought inflation was dead. But in 2025, the 60-40 model failed. Bonds lost money. Stocks were volatile. Inflation ate their returns. Pension funds are currently under pressure. They need yield. They need protection. So investment committees met in December and made a decision. We need hard assets. They're shifting their allocation models. They're moving capital into alternative investments and commodities. Let's look at CalPERS, the California Public Employees Retirement System. They manage over $550 billion. They recently voted to adopt a new strategy called the total portfolio approach. Instead of rigid buckets, they're targeting specific themes. One of their biggest targets, climate solutions. What is a climate solution? It's a solar farm. It's an electric vehicle fleet. It's a power grid upgrade. And what are all those things made of? Silver. When CalPERS allocates billions to climate solutions, they're indirectly buying massive amounts of physical silver. They're buying the metal needed to build the future. If the global pension system moves just 0.1% of their assets into this sector, that's $50 billion of new buying pressure. The entire annual mine production of silver is worth roughly $25 billion. Do you see the math problem? Pension funds are trying to buy 2 years' worth of global production all at once. It doesn't fit. You cannot buy $50 billion of silver at $75 an ounce without moving prices. There isn't enough metal. Therefore, prices must act as the rationing mechanism. Prices must rise until that $50 billion buys a smaller amount of metal. This is not speculation. This is fluid dynamics. When you pour a gallon of water into a shot glass, it overflows. Tonight, the water starts pouring. There's another crucial difference between this money and bank money. Bank money is hot. It moves in and out. They buy today, they sell tomorrow. Pension money is sticky. When a pension fund allocates to silver or climate technology, they're making a strategic decision for the next 5 to 10 years. They buy the position, they put it in the vault, and they sit on it. They do not day trade. They do not use stop losses. They remove the float from markets permanently. Every ounce that a pension fund buys this week is an ounce that will not be for sale at 80 ounces. It will not be for sale at 100. It is effectively sequestered. It joins the silver in solar panels and the silver in landfills. It is gone. This creates a ratchet effect on prices. Prices go up on buying, but they don't come down on selling because there is no selling. Available inventory shrinks every single day that pension funds are active. We are moving from a liquid market to an illiquid market where the only sellers are the desperate. How do pension funds buy silver? Do they buy coins? No. Do they buy futures? Rarely. They buy ETFs, exchange-traded funds, SLV, SIVR, PSLV. When a pension fund clicks buy on $100 million of SLV shares, the authorized participant creates new shares. To create those shares, the bank is legally required to deposit physical silver into the ETF vault. According to the prospectus, they must put the metal in the vault within a few days. Therefore, pension fund buying creates an immediate mechanical demand for physical bars in London. The bank must find the metal, but as we know, London vaults are running dry. Shanghai arbitrage has drained massive amounts of the available float. So where does the bank get metal to back new ETF shares? They must scramble. They must take it from futures markets. They must lease it from a central bank. They must bribe a refiner. This transforms the ETF market into a vacuum cleaner. It sucks up every available bar to satisfy pension fund demand. But what happens if they can't find the metal? What happens if major banks cannot source silver to back SLV shares? The price of the ETF disconnects from net asset value, or the bank fails to deliver. We are watching share creation numbers closely this week. If we see massive inflows into SLV but no corresponding increase in vault inventory, it means banks are creating paper silver again. They're selling shares backed by nothing. This creates a liability bomb. Eventually, auditors will check. Eventually, the physical shortage will be exposed, but in the short term, demand from ETFs forces prices higher because the algorithm tracks volume. Pension funds are the whale that banks cannot control. There's also the psychology of the fund manager. We talked about window dressing in December, but in January we have performance chasing. Imagine you're a fund manager. You see silver up 5% on Monday. You see silver up 6% on Tuesday. You see your competitor's fund going up while yours is flat because you own bonds. You panic. You must catch up. You abandon your discipline, and you buy what is working. You buy silver. This creates a momentum spiral. Buying begets buying. The higher prices go, the more attractive it looks to momentum funds. The charts look perfect. The breakout is confirmed. Volume is high. Every technical signal is screaming buy. This attracts quant funds, the robots we talked about earlier. They see the sharp ratio of silver improving. They see volatility skewing to the upside. So they increase their leverage. We are now seeing a convergence of fundamental flows and technical flows. They're feeding off each other, and there's nobody left to sell to them except short sellers who are already dying. Underlying all of this is the realization that inflation is sticky. The data coming out this week suggests that inflation is not going away. Oil is up, shipping is up, wages are up. The soft landing narrative is dead. Pension funds know that bonds are a losing bet in an inflationary world. If inflation is 5% and bonds pay 4%, you lose money. Real returns are negative. Silver is the only asset that offers positive real returns in a stagflationary environment. It has industrial utility, it has monetary history, it has scarcity. It is the perfect asset for the macro environment of 2026. The allocators have realized this. The memo has gone out. Get exposure to strategic metals. This is not a trade for them. It is a strategic pivot. It is a 10-year decision. They are moving the Titanic. And once the Titanic starts turning, it doesn't stop. The buying we see today is just the first degree of the turn. So the money is here. The squeeze is on. The institutions are chasing. We are looking at a market that has cleared resistance and is now searching for a new equilibrium. That equilibrium is significantly higher than where we are today. But with great velocity comes great danger. Volatility is going to increase, systems will strain, exchanges might halt. In the conclusion of this series, we're going to give you the survival guide for the rest of the week. We're going to tell you exactly how to handle a limit-up market. We're going to discuss the exit strategy again because you need to know when to sell to pension funds. And we're going to leave you with the final verdict on the perfect storm. You are in the middle of the greatest repricing event of your life. Do not blink. We have reached the final chapter of this investigation. We have analyzed the war trigger in Venezuela. We have exposed the Shanghai vacuum draining vaults. We have dissected the bank trap that forced shorts to cover. And we have mapped out the massive wave of pension fund capital that is hitting markets right now. The perfect storm has made landfall. Prices sit at $75, $60. The breakout is confirmed. The bear market is a distant memory. But now you face the hardest challenge of all, survival. A vertical market is not a safe place. It is a war zone. Volatility kills leverage. Emotions kill profits. As prices race toward $80 and beyond, swings will get wider. News will get crazier. The temptation to sell too early or buy too late will be overwhelming. In this final breakdown, I'm going to give you the survival guide for the rest of the week. I'm going to show you exactly how to navigate a limit-up market without losing your position. I'm going to reiterate the exit strategy because you need to know when to walk away from the table. And I'm going to leave you with the final verdict on the year ahead. The easy money has been made. Now comes the hard money. Let's finish this. I cannot stress this enough. If you're trading silver with high leverage, futures, options, margin, you are in danger. In a parabolic move, prices do not go up in a straight line. They go up $10, crash $5, go up $12. These washout moves are designed to liquidate leveraged traders. Banks know where your stop losses are. They will use thin liquidity to hunt you. We saw it last week with the crash to $70. If you were on margin, you got wiped out. You missed today's rally. Do not let that happen again. The strategy for this phase is deleverage. If you have massive paper profits, take some off the table, move them into physical metal, move them into fully paid mining stocks. You want to be in a position where a 10% drop does not force you to sell. You want to be unshakable. The only way to ride a bull to 100 is to make sure you can't be bucked off. We need to talk about circuit breakers. With the momentum we are seeing today, there's a high probability of hitting limit up this week. This is when the exchange halts trading because prices rose too fast. If you wake up tomorrow and the screen is frozen, do not panic. Do not call your broker. Do not try to sell on the black market. A limit up halt is the ultimate bullish signal. It means there are no sellers. It means prices are trying to find a level that doesn't exist yet. When markets reopen after a halt, they usually gap higher again. If you sell during the panic of a halt, you're giving away your position for pennies. Sit on your hands. Let markets clear. The exchange is trying to cool it down, but you cannot cool down a volcano. Let's look at the charts one last time. We broke $75. Where are we going? The next major technical level is $85. This is the 1.272 Fibonacci extension of the multi-year base. Algorithms are programmed to chase prices to this level. Between $75 and $85, there is very little resistance. It is an air pocket. I expect we will travel through this zone quickly. We could see $80 by Wednesday. We could see $85 by Friday. But at $85, expect a fight. That is where the first wave of profit-taking will hit. Early buyers will cash out. Banks will try to short again. Expect turbulence at $85. Do not buy the breakout at $85. Wait for the retest. Buy the dip after we clear the level. I'm going to repeat this because it is the most important thing you will hear. Do not sell for dollars. If silver goes to $100, it means the dollar is dying. Why would you want more dollars? You sell for real assets. Watch the gold to silver ratio. Right now, it sits roughly at 58 to 1. This is still cheap. We are waiting for the ratio to hit 30 to 1. That is the first target. At 30 to 1, you swap 20% of your silver for gold. You lock in the purchasing power. You trade the volatile metal for the stable metal. We are waiting for 15 to 1. That is the all-out signal. Historically, the ratio bottoms at 15. At that point, silver is overvalued relative to gold. You swap everything. You triple your gold stack. You retire. We are not there yet. We have a long way to go. But you must have the plan written down now, because when the mania hits, when your friends are screaming at you to buy more, you need a cold, hard rule to force you to sell. So here is the verdict on the perfect storm. It is real. It is here. It is happening. The war in Venezuela has ignited the safe haven bid. The Shanghai vacuum is draining physical inventory. The bank trap has forced shorts to cover. Pension funds are bringing the volume. This is not a drill. We have entered the supercycle. Silver prices are re-rating to reflect their true value as a strategic energy metal and a monetary reserve. $75 is just the beginning. You have done the work. You understand the fundamental drivers. Now your job is to execute. Stay calm, stay solvent, stay stacked. This is the year you have been waiting for. Don't blink. The greatest wealth transfer in history is underway. Subscribe.